oil marketing companies may finally be turning the corner after a tumultuous 2022. Their marketing margins improved in December. The margins reached a 10-month high of 2.4 rupees per litre on December 13, reversing course after 8 straight months of decline. Street watchers have started upgrading stocks of Hindustan Petroleum, Indian Oil and Bharat Petroleum as sharp correction in crude oil prices and turnaround in diesel marketing profitability make them attractive.
Most likely, with the recession narrative for the US and EU, and that China too struggling on the growth front, the crude prices have dropped and they are likely to stay low. So it's great for downstream OMCs. The outlook on the interest rates in the US is becoming clear. The peak rate is likely to be around 4.7, 4.8%, and that too will play out in the first half of 2023. And probably post that there is a likelihood of a rate cut as well. And once the initial shock that we saw from the hawkish tone from the Fed and even the FIs have been busy with their tax loss harvesting in the end of December, beginning next year we will expect that investors will come to their drawing boards with a fresh perspective, and that's where the long-term investors are getting an opportunity to allocate capital in this end of December or early next year, and definitely this which will give them time to buy into some of the attractive opportunities like this. But definitely this does not apply for low tolerance investors.
Crude oil prices are down to around $80 per barrel, falling nearly 40% from June highs of $125 per barrel. Analysts at Prabhudas Lilladher have increased marketing margins on diesel and petrol to 3.5 rupees for FY24 and 4 rupees for FY25. They have increased earnings estimate by 50 to 130% for the period. Remember, the upgrade comes after OMCs incurred standalone net loss of 21,200 crore rupees in H1 FY23, resulting in their debt rising by 69,500 crore rupees during the period. Most analysts have either buy or hold ratings on the stocks on the back of valuation comfort. They, however, see downside risks if OMC's auto fuel under-recoveries rise again due to a potential spike in crude price amidst supply concerns, and government gives limited compensation to OMCs for FY23 auto fuel under-recoveries. Meanwhile, outlook for oil upstream companies, or the ones engaged in discovery and extraction of crude oil from underground, remains cautiously positive as they try to balance the cut in windfall tax against low crude oil prices.
Global oil demand over the next few quarters may remain stable due to gas to oil switching and China reopening, partly offset by weak oil demand from European and Asian petchem sector. However, there are several supply-side concerns, including G7 imposed price cap of $60 a barrel on Russian oil and EU's embargo on import of Russian seaborne crude that came into effect from 5th of December, and embargo on import of Russian oil products which is effective from 5th of February 2023. OPEC plus strong pricing power amidst low inventory could also support oil prices. A cut in windfall tax could support revenue and profitability of upstream players. We do not think oil prices can remain below $70 a barrel for long.
Last week, the government slashed windfall tax on domestically produced crude oil and diesel effective December 16, 2022. The Ministry of Finance reduced tax on crude oil to 1,700 rupees per ton to 4,900 rupees per ton. The ministry also cut rate on diesel exports to 5 rupees per litre from 8 rupees per litre. Analysts at JM Financial have buy rating on ONGC and Oil India, while those at JP Morgan have an overweight rating on Reliance Industries. They see up to 40% upside in these shares from 1 year perspective. On Wednesday, global cues and stock-specific news flow will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.